Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to this week's episode of Market Talk on Friday, the 26th of September, 2025. For anyone new to our show, we pore over the past week's key market events and data highlights. And I'm joined by a seasoned professional, a market professional, to help me really just go over what we've seen and what to expect in the week ahead. And this week I'm joined by Sam Cutler, portfolio manager at 333 Capital. Hello, Sam. How you doing?
Hey, Harry. I'm doing pretty good. Yourself?
Yeah, very well, thank you. I'm just watching the Ryder Cup at the moment as well, which is always fun. Before we get into it, yeah, I know you've been away, but you've still been keeping a keen eye on what's been happening over the course of the past week. There's quite a lot to get into, really, especially this week, and potentially what we have or don't have coming up next week. A little teaser there too, what we might be talking about in the back end of today's show. Let's start though with what we've seen in the week just gone, and we heard from Fed Chair Jerome Powell. He made some comments on inflation, and he noted that the Fed cannot ignore the risk of higher inflation, despite giving the message that they were ready to sort of become more accommodative again, or shall we say, restart an their easing cycle, as they did with that 25 basis point cut. What are your views on what Powell said and how it feeds into the wider narrative that we've seen with the data? And we'll come on to the data, but with the data and current Fed policy.
Yeah, so I think, Powell, he kind of flipped. To me, he flipped and was a little bit more hawkish than, his clearly, I'll call it the dovish pivot at Jackson Hole, right? It seemed like they were very concerned about the labor market. It was a few headline things. And now, even this morning, you had some Fed members coming out talking about, the break-even jobs rate anywhere between 0 to 50,000. So I really think it's just a messy picture, and it's pretty hard to have a strong view in this kind of environment. But there's definitely several themes that are emerging, right? So like you said, if we want to look at kind of the inflation data, which we had today, right? Core PCE, came in as expected, unrounded at 0.227. The thing that stuck out a little bit there was that super core reading. Like, it's still pretty elevated at 33 bips. So I think there's a few things I want to touch on here, because I think this will also kind of feed into, kind of the stance of the Fed and kind of the difficulty and balance they have moving forward, right? So a lot of the fear in inflation has been on the tariff front, right? So I did a little analysis here, and I tried to strip out the estimated impact of tariffs on core PCE. And what I got is core PCE would still be running in the 2.7 to 2.8% range year over year if it wasn't for the tariffs. So tariffs, they're certainly a factor, but they're definitely not the whole story here. And I think, the consensus view amongst market participants and economists has been that, the peak in core goods is going to be less than initially feared. It seems like it's likely going to be a more persistent thing. And it's still, again, like we've spoken about, it's going to take a lot longer to feed through, right? We just had more tariffs kick in August. So right now we're seeing tariff revenue approaching, if I'm not mistaken, I believe it's close to about 400 billion at an annualized rate. And the pass through to consumer prices, it's definitely slower than expected, but it's still happening. And I still think it's going to take a few more months to work through those kind of pre-tariff inventories. And I think the PMIs this week gave us a good indication of that as well, and we can touch on that later. But one of the key questions I think we have to ask ourselves, and the Fed is asking themselves, is whether this goods inflation is going to spill over into the service side. So so far there's not really a clear transmission channel, but there's definitely some areas to watch, right? Like the airline industry. The lower capacity there is really sustaining prices. And then if you look at the medical sector, import content is really significant on the supply side. So that's where we could see a little bit of transmission there. So, all in all, I think inflation is really going to remain a pretty key headache for the Fed heading into year end. But they also have made it very clear in their recent communications that, if they really have a choice right now, they're prioritizing the job market over inflation. You kind of see that in the markets, right? Some of the inflation metrics not being taken as serious as, labor market numbers.
Sure.
And, we're kind of getting, look at the GDP reaction, right? Kind of good news is bad news for the markets, right? You get a really hot GDP print and, the market sells off.
Even though it was a third read, I mean, it did come in higher than we'd seen previously. And, everyone took that to be good news in terms of a soft, like you say, good news, bad news. Of a soft landing if a landing at all for the US economy. Do you think it's a Hobson's choice then for the Fed choosing labor over inflation, or it's just simply this is the situation as it stands right now and it's demanding of attention?
It's really just the situation as it stands right now, and moving forward, it's going to be a constant balancing act for them. I think the Fed's challenge right now is really navigating growth and inflation expectations, right? It's a pretty complex landscape. And to be honest, I think, the traditional relationships between growth, employment, and inflation are not the same as they used to be. So I think their goal right now is going to be really to try to avoid like a stagnation front.
Right. Okay. Well, we had durable goods out this week as well, and we saw that. I think we were expecting down 0.3%, and that beat by a stretch and a half. I mean, it came in, I think, over 3% for the headline rate. So, any story in that you can see, anything that gives you any kind of insight into activity, or was it another one of those anomalies?
Yeah, I mean, so the first thing I'd like to touch on though is something in GDP, right? So you did get the final estimate, right? 3.8 versus a 3.3, which is definitely a pretty significant turnaround than the contraction we saw in the first quarter, right? But one of the big things to me, and Powell references this a lot, right, is real final sales to private domestic purchasers, which is like, it's pretty much the key measure of underlying demand. This was revised up to 2.9%. And, to put that in a little bit of context, the advance estimate was 1.2% and the second was 1.9%.
Wow.
So, in case those who don't know what this is, final sales to private domestic purchasers is essentially the total value of goods and service is sold to private entities within a country. So it's really like the aggregate spending of households and businesses. So
which is key. Yeah.
Yeah, it's an absolute key component to GDP, and really it's a great insight into, domestic demand of the economy.
And that backed up what we saw with the retail sales earlier in the month, I think, as well, coming in so strong as well. That household is particularly resilient at the moment.
Yeah, and I think, you can make the case, right, that this growth is being driven by strong domestic demand, which is, probably supported by the wealth effect coming from, capital markets. And you want to touch on the durable goods, right? I mean, geez, that was a large gain, 2.9%, right? Versus, what'd you say? It was a slight decline, I think?
Yeah, 0.3, I think, was the expected headline. So, big beat on that front.
Yeah, and I mean, look, there were some details in it that were a little bit softer, right? Like core capital goods shipments that did decline by 0.3%. So, you can kind of take from that business investment might be weaker than, kind of the headline order number suggests. And then, some people are going to fight this, but, I think it's true that if you look at inflation versus real growth, right, you can kind of attribute some of the increases due to price inflation, rather than a real increase in kind of the volume of goods being ordered. But, regardless, it's still, an undeniably strong headline number there.
But again, as we've said many a time, you need to see a bit of continuation of that. You want to start seeing this as a trend, as opposed to these anomalous sort of readings every other month or whatever.
Exactly. And I mean, you want to talk about anomalies too. Look at the jobless claims. You had some fraudulent claims in Texas that are getting reversed. And then last week, you had the misprint and continued claims where North Carolina, I think it printed 205 and it was supposed to be 19,000. And this week, we claims hit a 9-week low at 218,000.
18,000, 280,000, close to cycle low.
Yeah, and I mean, that is somewhat in line with seasonal norms, right? We're right around the period of the year where jobless claims are kind of in a trough, and we probably are most likely to see them start to pick up after, week 40 of the year. So, in the next 3 to 4 weeks, we should probably start to see an uptick in claims come just from seasonal patterns.
But if then you look at continuing claims, it was a different sort of picture as they were near cycle highs as well.
Yeah.
So, even within that number itself, there's some conflicting sort of.
Yeah, and I mean, I think that's kind of really it's another factor in showing us the state of the labor market, right? We're essentially in a mass hiring freeze and not a mass layoff.
Okay. Yeah.
That's
I think
the simplest way to frame it.
Yeah. Good point. We did get other North American data in the form of Canadian real GDP. Obviously, we saw them cut rates the other week alongside the FOMC, ahead of the FOMC by 25 basis points. But their labour market's been in all sorts of flux at the moment. And obviously, they're suffering at the hands of their southern neighbours' tariff demands as well. Just a quick look at Canadian GDP and or the Canadian economy as a whole. Do you think we're looking at further cuts, or do you think they'll do a pause and just see and try and mirror the US in some regard?
I think they're at least due for one more this year. And I think the picture in Canada is a little bit different than the US, right? Q2 GDP was weaker than expected. The outlook for Q3 is still pretty soft. Like you said, at the last meeting, they cut 25 bips, but their statement was really non-committal, right? So it kind of suggests a higher bar for a cut in the future. I just think unemployment, I live here in Canada. I'm in Quebec and I see some of the things going on. Unemployment is a problem. The real estate sector here is starting to slow a little bit. I mean, look, the Canadian economy is essentially real estate. We're propped up on a huge, essentially housing bubble that, one day will probably deflate. Is that anytime soon? I have really no view on that. But like you said, in the US, tariffs, have also been a factor here in Canada. And, the weakening economy and very slow employment growth in some of these affected sectors is going to continue to kind of weigh on the picture here. But there has been a little bit of upside. I mean, inflation is pretty smooth here. I think core is running about 2.5%. And Canada, we did also remove the retaliatory tariffs. So I think that should ease a little bit of pressure. But, I still think the trend is pretty clear here, and it's going to continue to be a weak economy. And, I've been positioned for that in Canada, and I think it's still going to come. I think we're going to see at least one more rate cut this year from Canada.
Fair enough. We also saw rate decisions from the Swiss National Bank that kept rates and at near zero, I think it was. And we saw Riksbank surprise rate cut as well this week. So we've had a lot of central bank activity in the last couple of weeks, really. And we can always go into the divide amongst them in terms of those looking really to try and manage the inflation picture and those trying to stoke a bit of activity within their economies. But generally speaking, tariffs have been a conundrum for most central banks out there. Right, I want to turn to the week ahead. And because there's still loads happening this week. Obviously, the first Friday in the month, we've got new month. Next week, we'll have non-farm payrolls, perhaps. Now, when we'll find out, I think is it Tuesday, that whether we're going to get a government shutdown and whether that will actually affect the release of non-farm payrolls for September. I think we're looking for a slight bounce in payrolls this month. Not much. I think HSBC, I think we're looking for a bounce back towards 50,000 if I'm right. A number of agencies looking for a slight bounce back from last week's, particularly low level, really. So not much of a high bar. Any views on payrolls this coming week or the labour market more generally?
Not really. I think we continue to see a slowing, right? For me, it's, the headline number now, I think is pretty set that it's hard to take them at face value, like we spoke about. They're going to come in lower. I mean, like you said, I think the survey is at 50,000. I think, the probability probably lines up more on, a potential miss to the downside. I think the whisper number from Bloomberg's around 30K, still a little bit of an uptick from the previous one, but I think the focus is going to be mainly on that unemployment rate and kind of the trajectory of where that's going. But, like you did say, a government, if we do get that government shutdown, it could, delay this data. And I believe it was the other day, the Chicago Fed released a kind of new model on some more, real-time labor market indicators. That one had kind of the probability distribution of the unemployment rate. And I believe it was heavily skewed to pretty much staying flat to a slight possibility of rising by, zero point 0.1. So I don't think there's too much there, but I do think there is some risks in the government shutdown. And that is because I'm a big believer that, we've really moved from more monetary policy that drives equity markets to, in the long run, it's really the fiscal. Fiscal has been a major contributor to equity returns. And so I kind of try to view this as another lens of the economy, from the fiscal front. So if we do get a government shutdown and that cuts off a little bit of fiscal, we could, see a little bit of weakness come in from that. Because, if you look at kind of a headline level of fiscal, right? I think this week we drained like 74 billion, which is a little larger than the same period last year. And, the past 2 weeks, we've actually had a fiscal drain. And coincidentally, we've seen a little bit of weakness in markets here as well. And fiscal impulse continues to be really strong. I mean, it's running about 6% of GDP, which is, 84 basis points above the levels of last year. So the government is really providing meaningful support to the economy. So, if the government shuts down, and I think if you look at like the betting markets, they have about a 69% chance of this happening. I think this adds a fair amount of uncertainty to the fiscal outlook and kind of could disrupt a little bit of the fiscal impulse we've been seeing.
Well, I'll give you a note here from TD Securities. They say a government shutdown on the 1st of October appears likely, with our WRG noting it seems like a question of length at this point. While shutdowns typically have a modest effect on GDP growth, as you've mentioned, a shutdown now could exacerbate concerns about slowing economic activity. Shutdowns can also delay or cancel key economic data. Notably, a shutdown next week could delay the September NFP release. So just summing up really a lot of what you've just said.
I'll sort of touch on that too, Harry. Even let's say this jobs data is delayed, right? And then we have, I think inflation is on the 15th. It looks to me, just from watching kind of market pricing here, it doesn't really matter what this payrolls report or what the next inflation report is going to do to the October meeting. It seems to me that October is going to be a done deal for another 25 bits. But what has been moving around is that December meeting. Okay. So I think, October is pretty much said and done no matter what the data does, but we're going to see December price on what the data is doing. And right now that's at about 39 bips, and that's come down from the mid 40s. And I think, if you get somewhat of a decent employment report, I think you should still continue to see that those kind of basis points being sucked out. I really think December should be trading a little less than about 37 bips versus the current 39 it's at right now.
Okay, interesting. Just to give some of the comments then from some of the Fed officials, and there were a number of them speaking this week. You had Raphael Bostic of Atlanta Fed say that he supported the September cut, but opposed further easing this year, citing inflation risks. Alberto Muslim of St. Louis Fed called the cut a precautionary step, but cautioned against additional easing. Hamack there said favored a caution due to persistent inflation despite resilient labour market. Barkian highlighted inflationary pressures from tariffs and weak labour force growth. And Ostiner urged a slow approach, noting inflation remains above the 2% target. Add that to what we heard from the Fed chairman, Jerome Powell, who described the September cut as a maintenance cut, and it kind of makes you question, like you say, the October decision, and that puts more emphasis on actually what will we see in December. I mean, we get a new round of projections, I believe, in December as well. So that could help add or enlighten officials on where we're at by then as well. So just interesting from that perspective. Just quickly moving on then, we've got other bits and pieces of data out next week. Mainland China manufacturing PMI. So it'll be interesting to see where they're at the moment, considering everything that's going on around the world and demand focus for not just Chinese, but just generally global demand. Eurozone HICP, flash reading for September. The day before we get the Eurozone, we'll have France and Germany. We want to get onto Japan because it's going to be quite interesting. There's the Japan Tanking Index out for Q3. And that will be, that's a lot of policymakers, BOJ policymakers have said that this is an important index for them because it just gives them a better gauge of where the economy is ahead of what's expected to be an October hike. I don't know, I don't suppose you look at Japan too deeply, really, at the moment. But I mean, we've been hanging on for a rate hike from them for a while now, haven't we?
Yeah, so Japan's not something I watch very closely. I mean, I do dabble in the market, and that's been, just predominantly short JGBs, as that's been, the clear trend, using JGBs as a funding leg to, another long bond position. But it looks like they're going to get another hike in. I mean, October, I think they're implying about 13 bips, and there's about 23 bips priced into January to January, so the start of the new year. And I think that's that's probably about it. It's kind of hard to forecast out to 26 how that's going to evolve. But I think if you're trading in the fixed income space, I think JGBs are a great funding leg to some RV trades.
Okay, cool. Just also same with Japan. You've got the ongoing political situation over there. There'll be LDP leadership election coming up. Apparently, there were 5 candidates still in the running for the position of party leader, but Koizumi and Takachi appear to be the main protagonists from the party and public polls, apparently. So those two will be likely to be in the runoff, really, for the leadership and could really help frame the Bank of Japan decision-making process. So we'll keep an eye out for that. And then finally, we got RBA September interest rate decision due up this week as well. Expected to keep rates on hold. Again, this is from TD Securities. Says RBA testimony to the House of Reps suggests the board is unlikely to devote a significant attention to a cut at next week's meeting. Governor Bullock said, since the August meeting, domestic data have been broadly in line with our expectations, or if anything, slightly stronger. And Assistant Governor Hunter has indicated there are signs the economy is in a cyclical upturn. So be interesting to see what happens there down under as well. We're coming to the end of the episode, and so I'd like to thank Sam for his participation today. Thank you, Sam.
Yeah, always a pleasure, Harry.
And yes, again, next week there's going to be a lot of noise around the government, the US government shutdown. It seems the two sides now, the Republicans and the Democrats, seem miles apart. But we'll keep an eye over the weekend, see if any meetings that come about can do anything to rectify the situation and just put off a shutdown as of midnight on the 1st. But we shall see. And yes, non-farm payroll. We'll put out a preview for that as ever, and just see where the labour market is, because it seems to be the predominant concern for the Fed at the moment. So listen, have a good weekend, everyone, and thank you for listening. And we'll put another episode out next week. So yeah, enjoy your weekends, and come on Europe in the Ryder Cup. Cheers, Sam. Thank you.
Cheers, buddy. Thanks.
Just a quick reminder, the content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.